Hello and welcome everyone to the third edition of Standard Chartered Wealth Masterclass, where our endeavor is to demystify and de-jargonize key investment concepts and help make investing easier for our viewers. My name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank, India. I'll be the host for this webinar. We have an interesting topic today, how mutual funds can help you in your asset allocation. We will also try and see how different categories of mutual funds as per AMFI and SEBI. And to help us with this, we are joined by our guest speaker, Mr. Gaurab Parija. He is the Head of Sales and Marketing at Bandhan Mutual Fund. Gaurav comes with over 25 years of experience in sales, marketing and business development and also driving strategic initiatives. Gaurav has been associated with Bandhan Mutual Fund for over 6 years, and prior to that, he was associated with major institutions like Franklin Templeton Mutual Fund. Gaurav holds a postgraduate diploma in business management from IIM Bangalore. Thanks, Gaurav, for joining us on the webinar.
Thanks, Ravi, for the introduction, and great to be on the show. And thanks, Standard Chartered, for having Bandhan on your masterclass webinar.
Gaurav, before we get started, asset allocation is a key for the success of any investment a program, and there's been a lot of queries from investors over the recent times on how to use mutual funds as a tool to play your asset allocation, and also the various categories of mutual fund that seems to be a little confusing at times especially for investors who have no experience or are just about getting started in their investment journey. So over to you. Please help us understand how we can go about it.
So I'm not sure whether I'll be able to finally help all of you, but I'll give it a shot. So welcome everyone on a fairly wet evening, afternoon. Anyone joining in from Bombay, I hope you're all safe and sound. I'll load my presentation. Do let me know once you're able to see the screen. Can you see it?
Yes, Gaurav, we can see the presentation.
Okay. So again, thanks, Ravi, and I think this is a topic which is very close to pretty much everyone who represents the mutual fund business, which is asset allocation. Having said that, many a time it is so oft repeated and so cliche that people think that this is a jargon which all of us use for our own convenience. But we think otherwise, and we'll try to take you through as to why we think asset allocation is key. So the topic, like we said, is how mutual fund help in your asset allocation. What I intend to talk about are basically three things. The first is there a secret sauce to create wealth? And this is a question which in every forum people ask us that how do you create wealth? And trust you me, I think even you ask Bill Gates or Elon Musk, he will also be asking the same story or same question. The second is where do MS fit in this whole journey of creating wealth? And lastly, I think how do you choose a fund? It's a very elementary question, but while we might appreciate the need to have an asset allocation, while we might understand the need to choose a fund, how do you finally go about choosing a fund? So these are the three things I'll briefly touch upon. So to start off with, like I said, in pretty much over the last 25 years I've been in the industry, one of the questions I always get asked is, you all say that time is important, but is there any secret for creating wealth over the long run? And incidentally, and many of you might not be aware, there was actually a study done by one of the leading private banking firms in the US. While the study is limited to the US, they actually interviewed 250 households who were very wealthy, ultra HNI households, as to what was the secret sauce for creating wealth over their 25, 30 years of investment. And surprisingly, what the study found that there are fairly three simple things you need to do to create wealth over the long run, and that's what we call the mantra to wealth creation. And surprisingly, and while I might sound cliche and boring, 95% of the attribution of creating wealth was asset allocation, and that's screaming out as the number one point. The second was actually very interesting. It is saying that how do you manage one's emotion when it comes to your investments? And I think many of us will know that a typical investor moves between two broad emotions when it comes to investing. One is fear or one is greed. So and what we typically see that fear and greed actually work in contra to what it should. For example, when markets are low, we are also fearful that we don't go about investing in a risky asset class. But when markets are hitting all-time highs, we tend to let lose our guards and try to over-allocate an asset class which we shouldn't be. So how do you go about managing one's emotion is very, very critical. And the last one, I've tried to make it fairly simple, is a formula we've all read, and I'm sure all of us have passed class 10th, if not the higher education, is a simple formula where you substitute the NAV or the mutual fund with the potatoes and tomatoes and say future value is equal to present value into 1 plus r raised to the power n. And that actually is the magical formula we need to remember. And this is very simply put by all mutual funds in saying time in the market is more than time in the market. Now, if these are the three, and actually 5%, and that study stated, was attributed in anyone's ability to time the market. So 95% is asset allocation, managing one's emotions with your investments. And the last one is, remember the school ka formula, which is FV is equal to PV into 1 raised to the power n. Now, if that is the case, I'm sure all of us on this call know what is asset allocation. It's a very simple tool where basis your risk profile and your financial goal, you spread your investments across various baskets. It could be equities, real estate, mutual funds, golds, FDs, and cash. Now, very interestingly, and I use this slide fairly often, is that even Bollywood uses asset allocation. And just to let you know, I think many of you would have seen this movie. If not, do see it. It's a movie called Lagan. Oscar nominee of India way back, and if you've seen the movie, you actually see 11 characters which played a cricket match, and while Bhuvan, who's played by Amir Khan, was the lead, the match was actually won by this gentleman here called Kachra, who was a handicap player and actually started bowling leg spin and managed to take some key wickets. So you had multiple characters here, and what this very simply states is that, like in a cricket team, you need people with different personalities and different strengths. In your investment portfolio also, it is very imperative that you spread your assets across various baskets and not try to get all your investments in one basket, irrespective of what your risk profile is. So what is asset allocation? Very simply, two styles to define it. One is age-based, where we just broadly put one table. It may not apply to you in the strictest sense, and it's fairly generic that if you are in the younger age bracket of 25 to 40, your allocation is more into the risk assets or growth assets, which is equity. And as you age, you tend to reduce equity over a period of time and cut and increase assets which are more stable, which is your income funds or bonds and liquidity assets. Now, like I said, this is not a prescribed asset allocation for everyone. Again, it has to build in the risk profile. The second way to look at...
Yeah. An interesting point, Gaurav. In fact, thanks for bringing this slide up. At Standard Chartered, we also have something called a risk profile assessment. A customer's investment risk profiles assessment, where clients share their experience and knowledge levels based on which, and their risk appetite based on which the asset allocation of various asset classes like equity, bond, cash, gold, etc., are defined based on that risk profile. So, thanks for bringing this up.
Yeah, perfect. And I think whenever I saw this table, many people ask me that why have you put a very high number of equity even after the age of 60? And personally, I think one of the biggest challenges most Indians will face over the coming years is that you and I are going to live longer. So imagine you're working and you're a salaried person and you retire at the age of 60. The average mortality of an Indian is now hit 75. I'm pretty certain that most of us on this call would tend to live beyond 1995, which effectively means that 1/3 of your career or your life, you have to depend on the amount of portfolio you create post-retirement. And we all know that over long periods of time, the asset class which beats inflation is equity, and hence, most often than not, we actually ascribe a larger component of equity irrespective of person passing the retirement age. So that's why you'll see a fairly large component of 25. Now, the other way to look at asset allocation is what we call need-based. Now, while the table says that if you're young, you need to have more assets in a risky asset class or a growth asset class called equity, like Ravi pointed out, you would have various goals in that. And what we say that if your goal is for a very short term, that is less than a year, the key criteria of your investment has to be capital preservation, because you really don't want to take a chance on your inability to meet that goal. So you don't want to take too much risk on your investments. And that's where we think money market funds, short-term deposits, government paper comes in handy. And as you'll see, as you go up the ladder and you are saving for a fairly long-term goal, which is 3-5 years and above, that's where asset classes like equity and stocks come in handy. And that is where we believe that asset allocation can be either age-based or can be need-based. So where do MFs fit in all of these asset allocation journey? I think the beauty of mutual funds, and I'm extremely proud to represent the industry, is that pretty much mutual funds cover the entire gamut of solutions required across time periods. So you have on the extreme left equity schemes, and right towards this, you have fixed income schemes, you have hybrid, which is a combination of equity and debt. You have solution-oriented schemes, which are your children, multi-asset, retirement. You have other schemes which invest in international markets. And one of the things I keep jokingly tell my distribution and clients is that if you are to really dig deep into the type of funds mutual funds offer, there are only two types of categories or investor bases we don't cover. One is an investor who is yet to be born, and an investor who's actually passed away. If any other investment need or class you bring in, we'll have a product. So we have a fund which invests on a one-day paper, and we have funds which invest for perpetual bonds. We have funds which only buy corporate bonds. We have funds only which buy growth, large cap fund stocks, mid cap stocks, and so on and so forth. So if you are to convert that into a goal-based, and I put some random common goals which each one of us have. So if you are to looking for buying a car, saving for a vacation, it could be short-term goal, and hence a mutual fund which offers you short-term investment duration, high-quality funds. And as you go down the table, if you are looking to save for your retirement, which is 20, 30 years down the line, clearly that's a long-term goal, and hence you have to move away from a safer asset class into a diversified equity and hybrid funds. So that's where mutual funds come in. Now, having said that, what is a typical investment journey, or how does one investor go about choosing a fund? And the good part, at least for people on the call, is that you have a very solid partner in Standard Chartered and its team of investment advisors and RM, which can help you navigate in not only understanding your risk profile, but in able to determine what your goal is, and basis that help you choose the underlying asset allocation. So a typical investment journey would be a client comes to, in this instance, Standard Chartered, who, like Ravi pointed out, has the risk profiler, bases your risk appetite and investment horizon, tells you which underlying asset classes you need to invest in. They go one step further, and actually from that, they decide the category you need to invest in, and finally they choose the fund. Now this is a typical journey an investor follows when he's picking, going from left to right. Now, having said that, till 5 years back, the job was very, very difficult, because sadly there was a plethora of schemes across categories. There was no set definition of a scheme, and it made the job of people like Ravi and Udit and everyone in Stanchart even more difficult, because, like I pointed out here, your risk profile could basically hint at you investing in a large cap scheme. But there was no clear definition in the industry of what constituted a large cap scheme. So what could potentially happen or was happening was that you chose a fund A, which was supposed to, whose investment objective was broad. Its recent portfolio showed that it was a large cap oriented portfolio, and you went and bought this fund. But given that it had a very flexible mandate, over a period of time, it could have moved away from its large cap orientation and gone into a more flexi cap orientation. And that's when your asset allocation then is not in sync with what the plan was. And this is what happened, that there was just too many funds. So if you have to look at, there were 55 large cap funds 5 years back, but there are only 25 to 26 AMCs, which effectively meant some AMCs were running more than one large cap scheme. Now imagine the challenge the team at Stanchart had, and your challenge as to, if you chose fund A, which you presume to be large cap, it quietly moved to a different category. Now, and the concerns was this, that there were multiple funds with the same mandate. There was no uniform definition of a market cap. Even in a liquid fund, you had a liquid fund which had very high quality underlying debt instruments. You had a liquid fund with mixed quality. You had liquid fund with high expenses. So clearly life was getting very, very muddled, very challenging, and despite the best efforts of gatekeepers, many a time, given the fact that investment objectives were so broad, the gatekeepers also had to pretty much look at portfolios on an ongoing basis to figure out whether the portfolio was in line with what they had thought when they got in. Now, while we believe that this is their primary job in doing that on a day-to-day basis, do remember you are talking about 1,000 schemes. And 1,000 schemes changing portfolios in the middle of the month without disclosures is a very, very difficult and onerous task, the best of the best guys. And that is where I think today as we speak, things have become very, very different. Honestly, if you ask me, life has become simpler and structured. A lot of the noise around, yeah.
Yeah, just let me come in here. Thanks for the clarity on the changes that were made. What is your experience when you speak to industries and maybe large clients that you're speaking to? How has this change been accepted? Are clients or investors embracing this? Is it a step in the right direction, or you think that there's some work that still needs to be done?
Ravi, I think, like I said, most investors are very happy with the change and the changes which I will show over the coming slides, because of the fact that now they know when they invest in a particular category, let's say they invest in a large and mid-cap category, they know that the underlying fund has to have a certain minimum of investments in large-cap stocks and mid-cap, and there is no way, irrespective of the broad mandate the scheme would have had, that the scheme would dilute these two categories. And that is where it makes life very simple. For example, large cap, a certain percentage of your portfolio has to be in large cap. And that makes life simpler. Similarly, many a large client is or investor is saying, this is my risk profile. Once I plug into a particular category, forget performance. Performance is not defined by the category or regulation. I can at least sleep easy saying that there will be no deviation in the underlying market cap segment or the bond segment or the debt instrument. Earlier, like I said, you could have multiple variants of a single type of category of fund. So one flexi cap fund could have, or sorry, not flexi, one large cap fund like I demonstrated could initially be a large cap oriented, but suddenly change tack over a period of time basis the fund manager's view on the markets. Now, like I said, that was making it very difficult for a common investor to navigate the journey. Clearly, it is far more simpler. You don't have fund houses' ability to launch multiple funds in a category, so life is simpler. And at a manufacturer level, we are very focused that we have just one fund, do the best of it. And what was happening earlier was that because there was no restrictions on the launch of funds, manufacturers used to come and launch funds left, right, and center, because NFO is always a great time to pick assets. And over a period of time, if you had too many funds, obviously there will be a lack of focus on funds beyond the top 4-5, which is now getting corrected.
Yeah, and what has this done to the realized return experience since the category changes have been done? How has the intra-category return experience been? Has it converged, or still there's a wide variation, which was the case earlier? So,
Ravi, prior to this categorization, there was no comparison set. Means everyone chose their own comparison set, because in Stanchart you could perceive fund 1 to 10 as being large cap, but your peers could constitute funds 11 to 20 as being large cap. So we used to always struggle earlier as to where do I place my fund when I used to come and have conversations with clients saying, no, you know what, Bandhan large cap fund, Bandhan core equity fund should not be looked at as a large cap fund, but should be looked at as a non-large cap fund. So the conversations were very diffused. There was no clarity in comparison of funds. So you are at times comparing apples with oranges. Return perspective within a category will always be a difference. I don't think all the funds in a particular category will tend to outperform or underperform in a synchronous manner. Within that, there is still a large deviation, but what has made life simpler is everyone now can compare a category and look at the underlying funds, knowing very well that the investment universe of each of the funds is the same. From that perspective, it has made life very simpler. Return deviation will always be there because it's, again, in active funds, it It depends on the fund manager's perspective on a particular sector or stock.
Thanks a lot, Gaurav. Thanks. Yeah.
Yeah. So moving on, what has happened in 2018? A big change happened by the regulator, where very simply put, the regulator defined that every mutual fund there will be a set of categories with a defined mandate. In each category, a manufacturer or an AMC could have one scheme, either in an open-end structure or a closed-end structure. And the universe of large cap, mid cap, and small cap stocks were very well defined. So the first 1 to 100 stocks in terms of market caps were defined as large cap stocks. 101 to 250 were defined as mid cap stocks, and anything beyond that were defined as small cap stocks. Every 6 months, the Association of Mutual Funds comes out with the market cap ranges and redefines the 1 to 100, 101 to 250, and 250 and above. In line with the 2018 categorization, for the fixed income bucket, the regulator further added 2 more tools, which are riskometers and potential risk class matrix, mainly aimed at fixed income mutual funds, which further enabled a wiser decision of a investor, and we'll briefly talk about it. So if you were to look at the categories in the equity set of schemes, the categories broadly were large cap, and like I've been saying, there was a very specific mandate. So if any fund chose to be in the large cap category, the fund necessarily had to invest more than 80% of its assets in the 1 to 100 stocks, which were defined as large cap stocks. And this is where the game changer started, because earlier large cap had a very wide definition. So a mutual fund A could say a large cap stock is a stock with a market cap in excess of 50,000 crores. Mutual fund B could say my large cap definition is a stock above 75,000. All that went out of the window. A large cap meant the first 1 to 100 stocks as defined by market cap, and that's a uniform application of the category. So if you were to go across the segment, then you had something called large and mid, which effectively meant you had to have 35% in large cap stocks, the top 100, and you had to maintain 35% or more in the mid cap segment, which is 100 and 250. Then you have mid cap, which is 65% at least in mid cap, and so on and so forth. The categories which actually don't have any cap bias or agnostic of caps are actually flexi cap, and as the name suggests, flexi is portfolio manager can go across any market caps. So flexi cap can be, one flexi cap fund could be 80% large, 10 mid, 10 small. The other could be 40 large, 30 small, and 30 mid. No market cap mandates also were prevalent or are allowed in focused funds, in tax saving funds, value/contra, sectoral. But the difference in a sectoral fund is the moment you define your fund as to be a sectoral or a thematic, at least 80% has to be in that sector. So for example, if I say Bandhan Transportation and Logistics is the fund, I need to ensure that all given points of time, 80% and more stocks are, the investments are in stocks which meet the criteria of being in the transportation logistics. And lastly, dividend yield, which has to follow a certain criteria of a stock meeting the dividend yield characteristics. So this is where the equity scheme categorization happened. So for an investor, like I said, yeah.
Just to, as we're on the slide, just wanted to understand, for the viewers, if you could help understand why it is important to differentiate between the market caps, the large, mid, and the small caps. How does it influence or impact the investor experience?
Okay, so while I have a slide revisiting the investor journey, so if your risk profile is you are looking at a long-term goal, but you don't want to take very highly aggressive portfolio, I'm sure the advisors in the IA or the RM in Stanchart would say, sir, you should be more tuned to a large cap portfolio, because these represent the top 100 companies in India. These are companies which are, like the name says, large. They have been in business for long. They have established business models. Their corporate governance is very good. Their management quality is very high. And given the sheer size of these companies will tend to be weathering a financial downturn or a recession far better than the companies which are smaller than them. Now, the flip side of that is that given that these are very, very large companies in overall in terms of revenue, profits, and market cap, their ability to create oversized returns are also limited. So this is a great investment pick for someone who wants relatively higher returns than the other asset classes like fixed income or gold, but doesn't want to take the bumpy ride which is associated with the equity markets. And that's where large caps come in. But if you are to move to the other segment and someone young who is saying, no, I am going to invest for 30 years, I believe I can take the ups and downs very well. I'm okay if my 100 rupee invested goes down to 20 rupees in 3 years, but I want a very high alpha or a very high return over the next 10, 20 years. The advice would be that why don't you look at a small cap strategy? And a small cap, as the name defines, is a company which typically, so if you were to look at the index today, the 250th stock as defined by the AMFI, it has a market cap of 17,000 crores. That is the 251st stock, which is the largest small cap, has a market cap of 17,000. So the advice could be, okay, choose companies which are growing in their business, relatively small, leaders in their specific, given the way they operate, but potentially could become large companies over the next 10, 15 years. But having said that, remember, unlike the large caps, if there is a downturn, if there is a financial crisis, the small caps tend to take a beating in a drawdown far sharper than a large cap. So that's the way the investment universe changes in terms of your underlying risk profile. Now, moving on to the debt, unlike equity, there is also a series of categorization which is done starting from overnight, where the underlying investment has to be made in any paper which matures in 1 day. Then you have liquid funds, where any investment done by the fund in a paper has to have a maturity which is less than 91 days. Ultra short, where your average macular duration has to be between 3 to 6, and so on and so forth. And these are very well defined. Now, not only are the definitions done for the duration, but in many a case, the definitions or restrictions are there in the underlying asset class or the papers you can invest. For example, if you are looking at investing in a corporate bond fund, the fund manager necessarily has to keep greater than 80% in AA plus and above rated securities. In a banking PSU, the fund manager has to keep 80% and more in banking, PSU or PFI debt instrument, and so on and so forth. And the most aggressive on the debt clearly is the credit risk, where unlike the corporate bond, 65% has to be actually kept in AA and below. And it is very different from a corporate where 80% in AA and above. As you move on, the hybrid scheme, it is a combination of equity and fixed income, and I'll not get into too much of details, but like equity and fixed income, there are a series of categories in hybrid. Many of you are familiar with the dynamic asset allocation or the balance advantage funds. There, obviously, it has to be a minimum of 65 to qualify for the equity taxation, but the equity component can move. There is no fixed percentages. The earlier so-called balance funds have been split into aggressive hybrid or conservative hybrid. In aggressive hybrid, you have to maintain 65 to 80 in equity, and a conservative is 10 and so forth. Category is making a lot of multi-asset. That's a category where you need to have at least underlying successes with minimum. So you choose equity 10, debt 80, and gold 10. So you have equity 15, debt 25, gold something, and commodity at a certain. But all of them have to keep at least greater than 10%. The last categorization was solution-based, which is retirement, children. Yeah.
Gaurav, if I may just interject, the voice was coming a little muffled for the last 15 odd seconds. Maybe the last section, if you could just reiterate.
So, did you hear the aggressive hybrid and conservative hybrid?
Yeah. We did.
Yeah. So the category which is seeing a lot of traction nowadays is the multi-asset category. The multi-asset category, as defined, states that the fund manager has to invest at least in 3 underlying asset classes with 10% allocation. For example, multi-asset fund A can choose to be 30% equity, 35 in fixed income, and 35 in gold. Multi-asset B could choose to be 15% equity, 15% commodities, 30% in gold, and 40% in fixed income. So that choice is left to each fund manager or fund house. But the minimum requirement is 3 asset classes with minimum 10%. And so these are the types of hybrid scheme categories. Moving on, there are solution-based categories like retirement fund and children's fund. Fairly straightforward schemes with a lock-in of at least 5 years in retirement, where you cannot invest after a certain age, and children's is you can invest up to a certain age, but after 18 you have to necessarily you can't invest after you're 18. Then you have the index funds and ETFs and the fund of funds, which are both domestic or overseas. Now, if that was the case, and you remember the initial dilemma an investor had, that once he chose a large cap fund, the underlying, there were multitude of large cap funds, and hence his initial decision of buying a large cap fund would have been nullified if the fund manager made a change. Now it is very clear and simple. So today what happens is every AMC has one large cap scheme. They can decide, if they decide to have a large cap, they can have one. If they don't want a fund representation large cap, they may not have a large cap fund. But once they decide to have a large cap scheme, they can have only one. Either it's an open-end large cap or a closed-end large cap. You can't also have a closed-end large cap and also run the open-end. It has to be one. Secondly, you have to necessarily invest more than 80% in the top 1 to 100 stocks as defined on a biannual basis by the Association of Mutual Funds. At least 80% has to be in that. Now, what that does is, as an investor, you can absolutely sleep easy knowing that if my choice was large cap fund, forget again the returns or the underlying stocks. I know for sure that 80 rupees of mine is limited to the top 100 companies, which is a very, very different thing. 5 years back, where you thought you were getting into the large cap space, there was no definition of what a large cap stock was, which was the fundamental issue, number one. Number two, there was no requirement for the underlying fund manager to stick to that asset allocation, because he could go anywhere depending on his choice of the market or his reading of the market. And this is where life has become very, very simple. On the flip side, if you choose to be in a small cap fund, many a time what we found that when markets were very high, people used to go defensive and get out of small cap and buy large cap. Which, while it is good, but as an investor, I will feel very disappointed saying that, look, I wanted to take a risky bet. I know small caps are volatile, and hence I want my fund manager to go and buy small cap stocks. Why is he or she trying to be defensive? And this is clearly not going to be allowed today, because, as like I said, small cap fund by definition has to put 65% in the small cap stocks, which is 250 and beyond in terms of market cap. So this is where life and the investment journey is changing, and this is where you start fitting in that, let's say you are a conservative investor, your core portfolio then is fixed income. As you move down the ladder, the team at Standard Chartered can start bucketing the various categories basis for risk profile your needs. Now, not that they were not doing it earlier, but like I said, they thought they were getting into a particular style of fund, but over the period, the style could have happened. Today, that's absolutely not possible. Now, having said that, let me reiterate the fact that categorization has nothing to do with performance. It could so happen that the deviation between the best large cap fund and the worst could still be fairly high, but at least you can rest assured that it is because of the choice of the underlying 100 stocks in a large cap category is fund A defeating or beating the fund B by a big margin. It is not that fund A has chosen only to invest in the top 100 and fund B has gone and invested more than a certain percentage in the mid cap space, which is clearly not there.
Gaurav, as we are on that slide, just wanted to, understand in the satellite allocation on the debt side, you showed funds with duration and credit risk. Could you elaborate on how to go about choosing a fixed income fund, in the context of, my tenure for investment is short, or long, medium, or long, or also my riskiness or the appetite for risk within fixed income is high. So, what are the metrics that one should look at and choose?
Thanks, Ravi. A very, very pertinent question. So the way we look at a allocation framework for fixed income is by looking at it from a three-lens perspective, which is the way Bandhan or IDFs used to talk about it. Now, why is someone going and choosing a fixed income mutual fund? 9 out of 10 times you are looking at a substitute for your fixed income, traditional fixed deposit or a bond. Now, why do you go and buy a fixed deposit or a bond? Is predominantly there are three reasons. You are trying to protect the quality of the underlying instrument, and secondly, you are trying to limit the duration. So typically you buy an FD for 3 years or 4 years or 5 years. And hence we believe that your core of your fixed income allocation has to replicate a product which mimics a FD. And that is why we want people that your bulk of your fixed income cannot take a duration risk beyond a certain tenure, which is 3 to 5 years, and clearly cannot dilute the credit profile beyond what was available. So for example, if you went into Stanchart FD, you buy into a Stanchart FD because they are one of the highest rated FDs in the country. You know for sure your money is safe. Now, if you were to come into a mutual fund, you cannot dilute your holding of a Stanchart FD and say that I'm okay to take a paper which is rated. That's not the reason you are trying to move from a FD into a mutual fund. And hence we believe that there are 3 elements of a fixed income portfolio. One is the liquidity bucket, which is typically money which you keep away for up to 6 months. Anything ranging from 6 months and above, the bulk of assets go into the core. And core is defined by limiting duration and protecting credit quality. There could be 20 to 30%, again depending on risk profile, again depending on the advice and the conversations you have with your relationship manager or investment advisor on how much that person can go into funds which either dilute duration or dilute credit. And that's what we call the satellite bucket. And the core bucket being the bucket which is high quality and short maturity.
Thanks, Gaurav.
So quickly moving on, and these are the last 2 slides. And in addition to the categorization, I honestly think a very revolutionary tool has been introduced for fixed income, which is what is called a potential risk class matrix. Very simply, it's a 3x3 matrix. On the X horizon, you have a matrix of, it's called class A, class B, class C, which is defined by the credit risk the fund is taking. And on the Y axis, you have interest rate risk. Up to less than 1 year is 1, less than 3 years is 2 and 3. So the difference of this is that before you get into a investment into any fund, the fund manager has to define as to which bucket he is going to be present in on a futuristic basis, not on a retrospective basis. So let's say you are buying a liquid fund and you see a fund which is classified A1. What A1 means is the fund manager is telling you that I will buy, and A is given typically to any fund which is most of its investment, in fact all of its investments in AAA and above. So A will be given to either you hold all AAA or G-Secs. One is, that means the fund will always be investing in paper which is less than 1 year. So if you choose a A1 fund, you can sure, like the categorization, be assured that there will be no chance that the fund manager or the fund will move from a AAA to a non-AAA. The moment it does that, it's a violation of the regulatory requirements. And clearly you know that no fund manager will actively try to do it or will have an intent to do it. And that's where is the big difference, that this is not a post-mortem. This is like a precursor of the maximum risk or duration a fund manager can take in fixed income. This for me, for us, I think is revolutionary. It is telling each one of you that if you are buying into a fund, then this is only applicable to fixed income. What is the maximum risk on either sides can a fund manager take? And this we think is very, very important when it comes to choosing your fixed income mutual fund. Riskometer is an additional tool. It's pretty much like a post-mortem. It tells you the amount of risk a fund has taken based on the last portfolio. So that's the broad difference between a PRC and a riskometer. So with that, I will end my presentation and open up for any further questions you might have.
Thanks, Gaurav, a lot for the presentation. It was very detailed and very insightful. We have, in fact, a lot of questions on the chat box. So what I'll do is I'll summarize a few, and I'll take it, from low complexity to high complexity. So there are questions on, and you did, share the core and satellite allocation. So there's a question on what sort of mutual funds one should, choose at the start of the investment journey. So if you're young and you haven't invested anywhere, based on your risk profile, what should be the first few choices? And similarly, followed by when you're in the advanced ages, what type of mutual fund should you choose?
So for the first question, if you're starting on your investment journey, what I would sincerely suggest is before even investments, please ensure that you are adequately covered on your life and health insurance. I think many a time we tend to overgloss and overlook this aspect. While mutual funds are must-haves, but the first starting point actually, and you will be surprised that a mutual fund speaker is telling you to first buy insurance. I think it's imperative. Either your firm employer gives you that comfort. If not, you get yourself adequately covered from your life perspective. After that is done, don't get overzealous in trying to put money which you cannot save on a sustainable basis in mutual funds. So I would really urge you to look at your bare expenses in running your family or your life. Beyond that, if you are young, clearly, like I stated, if everything is hunky-dory, you should plan to be living for 9,500 years. And over that long periods of time, and if you're starting at 25, the asset class which you need to have overweight or heavily weighted is going to be equity. Having said that, life is not only about a long-term goal. There could be multitude of goals which would come up in 3 years, 5 years. For example, you definitely would want to start want to get married, let's say after 2 years, 3 years, 5 years. Those are medium-term goals, and your asset allocation needs to slightly change for that. Many of you would want to buy a car, let's say after 2 years. So that also needs to have a different. It's a very whenever I'm asked this question, I want people to define what is their point A and what is their point B. Until you're able to define your point B, my answer will be very generic, which is clearly not the best answer. But if I have one long story short, if you are investing for a very, very long time at an early stage, be overweight in equity funds. Now, as you go up the age ladder, your needs will change, your liabilities will change. But do remember, like I said, today there is a clear need that irrespective of your age, a certain percentage of your assets to be in what are called growth assets, which is equity. You could look at an age-based strategy that over a period of time you start rebalancing assets, or it's a need-based strategy. So you can choose either one.
Thanks, Gaurav. Now, once we've got a fair understanding of how to get started with mutual funds, there are questions on open-ended versus closed-ended mutual funds. So how does one deal with that? And the second question is active versus passive, and we'll get into more detail because there are quite a few questions on that a little later.
So the basic difference of an open-end and closed-end is like the name suggests. A closed-end fund comes with a certain end date of maturity that is for a limited period of time. Earlier there will be a lot of closed-end funds. What the regulator has done very recently is that you will not have any equity fund which can be launched in a closed-end, because the regulator has very simply stated that any paper you buy in a closed-end fund has to be maturing on the date or before the date of the closure of the scheme. So now, given that equity is open-ended, there is no maturity date, you will not see any closed-end equity fund coming. Now, why were closed-end equity funds being launched earlier? The reason they were launched were because they could be a thematic, they could be going after a very niche segment of the market. The fund manager might be investing in stocks with very low float and hence didn't want too much of in and out of the fund, and hence thought it best to launch it in a closed-end format. But in most of your investment journeys, I think today open-end funds, given the strictness of the categorization, you can get away with investing in open-end funds and really not look at closed-end strategies until it's a very, very differentiated theme. But like I said, that they only do fixed income. Where I think on the fixed income side, I still think there is merit in people looking at what are called target maturity funds. So as an investor, if you have an investment horizon with a fixed date, like say I need money after in 5 years, in 2028, I don't want to take any equity risk. There are a slew of debt index funds which will mature on a certain date, and hence your predictability of returns is significantly higher than an open strategy. So that would make sense as against a normal equity strategy.
Thanks, Gaurav. Now, coming to active versus passive, is one better off choosing a large cap index fund or an ETF versus an active fund, given that the horizon could be 5 year, 10 year?
So again, at the cost. I'm approaching this not as a manufacturer, but as a person who's been in the industry for long. I think clearly with the categorization norms kicking in, there will be phases when active will outperform, but there will be phases when passive will outperform. But over long periods of time, and data has actually started showing it, that large cap active funds slightly lower than the next, predominantly coming out of the fact that many of the large cap funds have a slightly higher expense ratio than the passives. So if you have to nullify the expense ratio, most active funds actually are outperforming. Now, again, depending on how much of allocation you need to have in large cap funds, you could have a diverse split between 50% large active, 50% large passive, and that's how I would approach it, and not go 100% passive, because there would be phases like in the recent past where passives have actually underperformed the active space. So there is no clear answer for it, and to be safe, I would just put 50-50 in each category.
That was a safe answer, Gaurav. Yeah. So now that we've understood active versus passive debate, there are also questions on whether there are enough ETFs and index funds to play thematic ideas. For example, you just mentioned that if you want to move up the risk ladder and allocate into some sectoral and thematic ideas, do you have ETFs or index funds to play all of that, or it's still in work in progress?
Actually, there were quite a few, but Ravi, one of the things at least I try to practice, and the other thing of creating wealth, is there is a concept of sizing, which effectively means that if you are putting in 100 rupees in equity and you want to split your assets, if you are putting 1 rupee out of 100 in a very exotic idea, and that 1 becomes 5, and the balance 99 don't give any return, the overall portfolio return doesn't change significantly. Now, while people are all fascinated about finding the latest niche ideas of the themes and all of that, if you really want a theme, bet big on it. So go up to 10-15%. Otherwise, don't try your hand in putting 50 paisa, 1 rupee, 2 rupees out of 100, because it just complicates your portfolio. Your ability to track it is going to be very difficult. Now, coming to the broader question, are there enough themes which are there in the market? I would say, yeah, starting from a FANG, which invests in the top 10 tech stocks in the US, to pharma, to IT, to consumption, to business cycles, to defense, to I honestly think that we pretty much covered. Yeah, some of the categories like chemicals is not covered, but over a period of time that will also get covered. But for most of us on this call, the secret to creating wealth is not again choosing the right theme. It is about asset allocation, keeping it simple, going with the broad categories, and trust you me, you will make as much money as choosing a passive a theme, which is very, very different. Now, the other thing on the theme is, please go and buy a thematic fund if you understand that theme. Just because it is done well in the recent past, please don't jump into it. I think that's where Ravi and the entire team at StanChart come in even more handy, because they'll be able to cut the noise out and present to your theme, which is forward looking, not backward looking. And I'll give you a very recent example. 2 years back, 1.5 years back, the theme which was the darling of the stock market was IT. Today, many people who had invested in IT 2 years back are really not talking about it, because it's off 30, 40, 50%. And today the theme has moved. Now, I personally believe that all of us in this call are into a certain profession. Please focus on your profession. You will make far more money. Leave it to these folks in Standard Chartered. They'll help you navigate this maze. Just go by a very simple, common sense approach to investing, and you'll make more money. Until you know the theme and you are part of the theme. So if you're working in the defense sector and you know defense sector will do it, please buy. But buy with a certain size. Don't put 50 paisa out of 100 and expect to make too much money.
Thanks for that, Gaurav. Now let's understand, there are a few questions on systematic investments. So SIPs and STPs particularly, how can they be of utility for ones that are just about getting started in the investment journey and do not have too much money to save, and the ones who are worried about markets are very expensive, it has run up, it has rallied quite significantly. What is the best way to invest in equities?
So SIP clearly, like you stated, is for someone who doesn't have the capital but wants to invest, and hence I think systematic is the way I look at systematic is an analogy to our provident fund. In any job, 12% of our salary gets deducted for our EPF. That's your SIP equivalent. And like I think many of you know, that is the sure short way of creating wealth over a long period of time. STP on the other hand, like you said, are for people who want to play the equity markets, are not certain of time. Having said that, on a personal basis, where I think people make mistakes on STPs, they do STPs for 6 months, 12 months, which I don't think is the right thing, because if you're trying to navigate a cycle of the market cycles don't move in 3 to 6 over 24 to 36 months. So if at all you are not convinced on the market, start a STP, monitor that STP. If you get market occasions to change the STP into lump sums, stop your STP and go in lump sums. So for example, you started the market at a high of today, whatever levels today markets are, and market cracks 10%. I would immediately expect that you should get back to your RM, stop the STP and go and make a lump sum. STPs are not fill it, shut it, forget it, in my opinion. STPs have to, if the market is on a straight line forever, that's where the STPs are over a period of time. But if market makes a unidirectional move, you have to make a decision basis that. It can't go on forever.
Thanks, Gaurav. Now, quickly, we are in the last 5 to 7 minutes of the session. So what we'll do is we'll quickly take, rapid fire like questions. So people have questions on value and contra. So what are these value and contra funds briefly, and who should invest in them?
So value contra, I think the regulator could make one more category, so it bucketed two into one. Value funds are basically a fund which looks at stocks which are seemingly undervalued in terms of price to earnings, price to book, and debt to EBITDA and all of that. Contra, like the name suggests, is a category of funds where the fund manager wants to take a bet on a segment which is not doing well but has the potential to do well. For example, today everyone is saying take a contra bet on pharma. Over a period of time, as IT starts cracking, people will say, okay, let me take a contra bet on IT because the inherent story of IT is good. Today it doesn't look bad. People are not wanting to touch it. I want to take a contra bet. So those are two actually broad, very different categories, but sadly bucketed in one overall category by the regulator.
Could you help us understand briefly duration risk and interest rate risk, how it impacts the choice of funds?
So actually both are the same. Duration risk and interest rate risk is same, and from a very simple perspective, as an investor, what you need to understand and ask for is, for every fund there will be a characteristic or a ratio which is printed called the maximum duration or modified duration of the fund. So let's say the modified duration of a fund is quoted or shown to be 4 years. Very simply mathematically understand if interest rate rises by 50 basis, there is an inverse correlation of interest rate and modified duration. Your return or your fund will drop by the rise in interest rate multiplied by the duration in the negative way. So if interest rate goes up by 1% and the underlying fund has a 4-year duration, you will lose 4% on the same day, and vice versa. So it's a very important aspect in the volatility of the underlying fund. So many a time you will see a dynamic bond fund where a fund manager could have a duration of 12 years, which effectively means that if interest rates will rise, you could have a very bad time, but if interest rate fall, you make a lot of money.
And to add to that, how different is a credit risk?
Credit risk is where the fund managers invest in an underlying debt paper, and whether the debt paper is inherently riskier than, so the safest credit risk paper is the government security, followed by a AAA, AA plus, AA minus. So the challenges in taking a diluted risk is the challenges of default. So if you put money in a Government of India paper, the chances of default are pretty much zero, versus going into a AA paper where the chances of default are high. So when you buy a credit risk fund, what you get compensated hopefully is that there is a higher yield which you get compensate for the risk you're taking. So interest rate risk is there across all debt instruments. Credit risk obviously is starting to get elevated as we move down the risk ladder of government securities to other types of papers, the ratings, the low ratings.
Okay. Now coming back to there are questions on ratings. So there are a lot of star ratings and fund ratings available on different portals. Uh, how does one go about choosing the right fund, or a fund that could do well for the investor?
I think for all of you on this call, don't get too caught away with all the other ratings. Just go by what Standard Chart ratings are. I think don't try to complicate yourselves with looking at multiple rating. It just confuses all of us. Given that you have chosen Standard Chartered as your partner to create wealth, clearly their model has been tested for over long periods of time, and you should be more than happy in just going by their recommendations. I think every rating has its pluses and minuses. So I don't think any rating house can conclusively say that I am the best. If that was the case, no other rating agencies would survive. So I really can't say whether Value Research is better than Morningstar, is better than your star ratings or all thing. If you have chosen here, you've chosen it because they have over periods of time demonstrated their ability to filter out the good funds from the others. And do remember that no one in the world can predict the best fund over the next 5 years. As long as they have a tested process which is coming at the choice of funds, you should be happy with that.
There's a very fundamental question on how to use mutual funds, and for building wealth over a period of time with annuity payouts, or funding annuity requirements at a later stage. Is there a possibility to use mutual funds for that?
Oh, absolutely. I think we've talked about systematic investment. We've talked about systematic transfer. I think mutual funds offer systematic withdrawal plans. So the way to actually build your portfolio is what I call step in, step out. So you step into your investment journey in your accumulation phase by doing SIP or STP, and you step out of your investments by doing a SWP in your distribution phase. So what you need to do is, if you need an annuity, like I showed in one of the goals, instead of committing a certain amount into the fund, you go back to the fund and say, requirement every month I need to pull X amount of money. It could be a money linked to a percentage, or it could be an absolute amount from the fund. Typically, what you should do is, if your expected return on the underlying fund is X, choose to pull out X minus 2%. So you don't run out of the funds over longer periods of time. So for again, and not to be quoted or committed, if say you believe an equity fund over the next 10 years is going to give me 10%, ask for SWP at a 6%. So it's a perpetual annuity in that case. Don't overdo it, where you invest in a liquid fund which will typically give you 5 to 6% and ask for an annuity of 10% because the money will run out in a certain period of time.
That's insightful. One last question, and this is also a key question. How important is the fund manager's existence in the fund for a long period? Do changes in fund manager impact the fund performance?
So I would be naive in saying no. And while everyone keeps talking about process and frameworks and all of that, the fact that there is a fund manager in the midst of it means that he or she brings to the table his thoughts, his emotions, his understanding of the stock. But over a period of time, you have to look at if 100 rupees of alpha is created, how much comes from the fund manager and how much comes from the process. And for most fund houses, the intent or the focus is to move that 100 rupees of alpha more towards the process or the framework or philosophy and less on the fund manager. But if any fund house were to come and tell me that if I replace Shankar Narayan with Gaurab Parija and the fund will still do well, I think you are living in a cuckoo's world. People bring their own qualifications and competencies to the fore. Or if Manish Gundwani were to be replaced tomorrow by Gaurav, will the fund perform the same? The answer is a clear no, because he brings into the table certain set of competencies. The intent of every fund house is to try to diminish that competency to a lower limit, but can it completely substitute it? Then there is no need of fund managers. The AI models could take over. So I honestly think it's not a 0 and 1. There is a mix of both. Good fund houses will try to reduce the dependence on the fund managers, but can they completely take it out? You name any fund managers of the world, starting from Milgros to Peter Lynch and all. There will be a change. Now, will it completely fall off? The answer is no. But there will be a style drift which will happen.
One last, and we'll pass the time, but still one last question. and I think this is an important one as well. There are a lot of fintechs and RIAs, registered investment advisors, with SEBI. Should an investor approach them, work with them for guidance, or a mutual fund distributor would do an equally good job?
Firstly, fintechs are for those who understand the nitty-gritties of, even after the categorization, of navigating through 500 schemes. And while we believe we understand it, the answer is a clear no. It is, and the example I keep giving is this: like, you have a headache for a day, you take Disprin. You have the headache for the second day, you pop in a Disprin. But if the third day also, doctor. And that's equivalent to a financial journey. You may not want to reach out every day to talk to your financial advisor or RM, but in this whole hustle bustle of what we do, for example, I've been in the mutual fund industry from 1995, but I still use a distributor because I have 20 other things to do than track the markets, track my portfolio. Now, if you think you have all the time in the world and this is the only thing you do, please go ahead and use a DIY. Now, from a RIA perspective, there is just too much noise on the fee base and the cost aspect of it. I think the cost which you pay today, if the alpha comes over and above the cost, you should be fine. And the good part in a mutual fund, its costs are all embedded in. So what you see in the NAV is the full cost. It's not that there is a cost over and above that. So the question between fintech and this is very simple. I choose to be with a distributor, except obviously when I buy a liquid fund overnight, I go direct because there is no involvement of anyone there. But if everything else, and again, for many of us on this call, I keep telling that all ability to are there than focusing on something we are not adept in. We can leave that to your RMs and advisors.
Thanks a lot, Gaurav. I think we have passed the time slightly, and I think we've covered most of the questions that we had in the chat box. We've clubbed quite a few together, so we were able to cover most of it. Now, before we conclude the session, we'll just play a video on our SC Invest, our digital capabilities at Standard Chartered Bank. And we will connect back again next month with another interesting topic. Thanks, Gaurav, for taking us through this session.
Thanks, Ravi, and thanks everyone for joining in.
We will now conclude the session. Thanks, everyone.